Sometimes people refer to as a life insurance policy as a piece of property. So let's say I own $500,000 life insurance policy on myself, and whoever's the beneficiary is, whatever, okay? Because it's a piece of property, then we can look at it basically in a way that we can assign this piece of property. It's like we could assign any kind of property, right? So we have this, what we call an assignment of policies. This is very important because many people end up doing these kind of things. Okay? And there are two kinds of assignments that we're referring to here. What we call absolute assignment and collateral assignment. Let's take a look at absolute first. When we're referring to absolute assignment, what we're really doing is transferring the policy, okay? So the ownership, basically, it's the transfer of ownership. So I own a policy on my life, so it's a personal policy, basically. And now I'm going to transfer that policy over to, say, to a charity. I want to leave money to a charity, lasting legacy, you know, things of that nature there. So I'm going to transfer ownership of that policy. So it's gone from a personal policy now to a third-party policy, in that the charity now is in fact the insured, I am the life insured, and of course the beneficiary will be the charity as well. So the end result is that in the process of transferring that policy over, therefore, I have disposed of that policy, okay? Now, I say to a charity, remember that it could be to anybody. So if you and I were partners, for example, I own a policy on you, and you own a policy on me, and we decide to dismantle the partnership, and I need that coverage. Okay, so you transfer ownership to me. So it's gone from a third-party policy now to a personal policy. So the exact opposite. Okay, so in an absolute transfer, really what you're doing is changing ownership. Whoever owns it now transfers ownership to somebody else. Now, in the process of transferring, of course, one thing you must be aware of is that it may trigger tax. That's beyond the scope of this particular lesson, okay? But basically, it's not something to be aware of, that on disposition, therefore, and this, of course, only applies in a cash value type policy, so whole life policies, universal life policies, whatever. So the difference between the adjusted cost base and the amount of cash surrender value to say the policy, that difference will be triggered as a tax liability. But like I said, that is beyond the scope of this particular ownership, the policy at this point. Okay. Now the new owner, of course, now has all the rights. So essentially, once I've transferred ownership to that charity or to that individual or whatever, okay, then obviously all the rights that I enjoyed in that contract now automatically get transferred to the new owner. And so the end result of all this is I basically have lost control of the policy. I am now simply a life insured, and that's it. So when I pass away, the money gets paid to the new named beneficiary, whoever that may be. Obviously, if it's a charity, they're going to name themselves as the charity, as the beneficiary. But basically, all the rights that I've enjoyed on this contract, whatever they may be, will be extended to them. So, for example, if it's a cash value type policy, remember all of those forfeiture options that I was on, loan, APL, borrow money against the policy, all of those things there, all those rights and privileges are now transferred over now to the new owner. Because you remember in previous lectures, we've said that the insured has all the rights. Now the insured is the charity. I'm simply life insured. I've lost all those rights. Okay. Now notice I'm saying is that this is an absolute assignment. Okay, this is not a viatical assignment. In other words, you cannot sell the contract. This is basically you decided that you wanted to. So you cannot sell the policy for cash. It is illegal in Canada to sell your life insurance policy for cash. Okay, you can willingly transfer that, and like I said, there could be some tax implications basically. But essentially, we're saying is that you cannot do what's called a viatical. In other words, somebody giving you money to buy the insurance policy from you. It has to be done willingly without any conditions attached. So the absolute assignment basically is a non-conditional act that you decide that you're going to donate this policy, say, to a charity, or even transfer this policy to somebody else, and so on, with no gain beyond that. Okay? So that's the absolute assignment. And as I said, in this case here, you have lost complete control. And so when you die, nothing goes to your beneficiaries that you might have named before. Everything goes to the new beneficiary, whoever they've assigned, they've named. Collateral assignment, on the other hand, is you have no disposition here. In other words, you still control that policy. So it still is a personal policy. So I still own that policy. All the contractual obligations are still mine. The beneficiary is still the same. Nothing has changed. All I've done now is I've transferred over, you might see, put a lien, and I've assigned a collateral to a third-party lender. So if I have a $500,000 policy, and the bank says, well, in order for us to give you a $250,000 loan, a line of credit, whatever you want to call it, you need to be insured, okay? And you need to have us as collateral assignees. Fair enough. There's a collateral form that has to be filled out. Basically, that it gets filed with the insurance company, so it's a matter of record that your $500,000 policy now has been assigned to the bank or trust company, whatever, third-party lender, basically. And that way, it is a matter of public record, basically, that there is now a lien against this policy. One way of looking at this is, for example, if you have a $500,000 piece of land, you go to the bank and say, I want to build a house on this. I'm prepared to put the land as collateral. So give me, $250,000 so I can put a house on it. So give me a mortgage, let's say, of $250,000. It's the same idea. It's the exact same idea. So there's a lien against that. And so now, when the loan is paid off, then the assignment, of course, is in effect released. Okay, so at some point, let's say I now have in fact paid back that $250,000. Then, of course, it all gets released and everything, and things are back to normal. But unlike here, where I've lost control of the policy, here you see I don't lose control. I still maintain that control. I still have the beneficiary. I have all the rights are still mine. All I've done is I put a lien against that policy. And that lien will have to be paid out unless I paid it off before, in which case then the assignment is released. Okay. But let's assume that I'm dead. I died along the way, 15 years later, whatever it was, the client is dead. Then the loan gets paid first. So let's say 15 years from now, my $250,000, $150 is still outstanding. I still have to pay $150,000. So I die. The insurance company notices that there was a lien against the policy, it was registered against the policy. They will phone the bank and say, Mr. Bank, your client is dead. We noticed there's a loan against this policy. What is the outstanding balance? They say $150,000. What the insurance company will do then is they will pay off that $150,000. So here's your check, and so therefore it's released now. The balance of the money, okay, the balance in question here, $350,000 in this case, okay, will be paid to the beneficiary. Okay, so basically what you've got is two checks are cut. One is cut to the loan institution, bank, trust company, whatever, okay, and the balance of that will be paid out to the beneficiary. So if you're asked which one of these two reduces the amount of money that goes to the beneficiary, it is the collateral assignment that reduces the amount that goes to the beneficiary, because this is entirely gone, it's finished, it's over with. So when I die, a whole $500,000 goes, and that's it. Okay. Here, the portion that is still outstanding is paid out to the institution. The balance of that money then will come to the beneficiary. So if you're asked on the exam or whatever it is of these two, which one of these two actually reduces the amount of money that gets paid out to the beneficiary, it will be a collateral assignment. So in both cases, very, very useful purposes for insurance policies. I should also mention that in the collateral assignment, because there is no actual disposition, there's no tax implication. See, here, there's tax implication because I've actually, might say, given my policy away, so I've disposed of my policy, be it a gift, whatever it is, it's gone. And so therefore, there is a deemed disposition in this case, and therefore it could trigger some tax. In this one here, collateral assignment, I haven't disposed of the policy. I still have the policy, still in my name, so I haven't done anything to it other than I put a lien against that property. And because of that lien, it's not a disposition, and so therefore, a collateral assignment, there will be no tax implication whatsoever. Okay, it's as simple as that. It will not trigger any kind of disposition, and therefore not trigger any kind of tax. And we, of course, will leave it there for now, and we will see you again.